Well, let's get over to Washington. Matthew Reed is there. He's Vice President of Foreign Reports. It's an energy consultancy specializing in the Middle East. Thank you for joining us, Matthew. Now, an attack on the oil facilities of Kharg could really have repercussions for the oil market.
Absolutely. Kharg Island is really the beating heart of Iran's oil industry. To attack those facilities would invite Iran to do the same in kind, or at least step up attacks around the Gulf.
Now, the thing about that is that we've got, at the moment, an oil price, $100 a barrel or thereabouts. Is it, at the moment, a bit slow in terms of reacting and pricing in what's happening and the repercussions down the line of what may well happen?
Well, it's definitely a process. I mean, for the first week of this conflict, oil prices jumped, but they also were volatile. So we were up some days, down other days, overreacting to headlines, undershooting others. But certainly the direction we're headed in is up. The longer this drags on, the harder it will be to try to find alternative sources of the oil the world needs. Right now, we're talking about at least 10 million barrels a day that is now stranded in the Gulf. That's just crude oil. Add to that over 4 million barrels a day of refined products that would be sold beyond the strait. And then something like 11, 12 billion cubic feet per day of LNG, for which there's really no easy replacement for.
Now, one analysis suggests that while the world before this conflict was awash with oil, the blocking or closure of the Strait of Hormuz is leading to a supply deficit of about 3 million barrels a day in March, rising, they project, 7 million a day in April. Well, you've got, strategic reserves here, which may well be opened up, but is that just a short-term fillip?
Strategic reserves, in this case, are really a Band-Aid. And by the time that oil hits the market, it might be too little too late. Remember that the big headline this week was that 32 members of the IEA, OECD countries in the West, and some others decided that they were going to release something like 400 million barrels of crude oil. The problem, though, is that as big as that number sounds, it's not that much if you consider the fact that that oil is not going to arrive in the market all at once or quickly. It is going to trickle out when what we're seeing in the Strait right now is a massive, massive disruption. Yeah, it would not surprise me at all if a few months from now, if nothing changes, if we stay down this path where neither side is looking for an off-ramp, both sides are potentially escalating, it might not be too long until we are talking about more strategic releases later this year.
The thing here, Matthew, also is that it's probably easier to turn the tap off than turning it tap on again, and it would take time even then for that oil to hit the global markets.
If the conflict magically stopped today, if Trump declared victory, if the Iranians announced a ceasefire, said they were no longer going to target ships, we would be weeks or maybe months away from normal. And that is a long, long time in this market when sentiment is so fragile. So going back to your question about price, we're at $100 a barrel now. If this drags on for another couple of weeks, we are going to be talking about prices probably closer to the levels we saw in 2022. The reaction to Russia's invasion of Ukraine boosted prices up closer and above $120 a barrel briefly. We could be there by the end of March, I think, easily. And if this lasts even longer, let's say the base case scenario turns into the worst case scenario. If this drags on into spring, another month or two, we are probably going to be talking about prices that are as high as they've ever been or higher. And then, the next step after that happens, and let's hope it doesn't, but the next step we're going to be talking about is the extreme, extreme cost to the global economy, which could be not just a headwind, but a driving force for a recession. If we get up close to $150 barrel oil, the only thing that can possibly follow is demand destruction, slowing economies. It could be devastating.
Right. So do you think that at the moment these investors are underpricing what's going on? And I just want to very quickly also talk to you about what about the gas market here too?
Well, to the question about underpricing, I wouldn't call it underpricing. It is a process where the markets are trying to game out whether or not there are off ramps, how soon this could quiet down. And what we've seen is oil prices, at least, are already up almost 50% over 2 weeks. And that even though $100 a barrel sounds relatively low given the stakes, we are seeing a gradual, steady climb in the wrong direction, which is up. So prices are starting to reflect the reality that this is not going to end soon. And then when it comes to gas, the volumes of gas that have been shut in by this closure, by closing the Strait of Hormuz, are so large. We're talking about 20% of the world's liquefied natural gas that is now trapped, now that the Qataris have been forced to shut in production. There is no easy fix for finding that gas. There are no, it's almost impossible to replace those cargoes on short notice, and let alone sustain them going forward.
Matthew, thank you for your time. Matthew Reed, there, Vice President of Foreign Reports, joining us from Washington.
Thank you.